Hey guys, it's Seth and Paul for the Everything Money channel. We are again here in the office on Zoom. Paul's right down the hall from me. And we talked today about the craziness again of Tesla. Paul is still an enormous hater, and I argue with him again about why Tesla is the best company ever, and he'll prove to you right now that it's certainly not. So stay tuned on the Everything Money channel, baby. Hey everybody, it's Seth and Paul for the Everything Money channel. Thanks for joining us today. Paul, you wanted to get, this is weird now. We are in our beautiful studio, Paul. Not really. Is it you're in your office, and I'm in an office down the hall, and if I scream loud enough, I could talk to you. But because of with the mask mandate, we thought that a mask and podcast would be sort of absurd, Paul. So, but in essence, I think the catalyst for this podcast is not only for our viewers to smash that like button right now, pretty please with sugar on top.
Please hit the like button. Actually, everybody's been doing pretty well about that one, Seth. And we really want to increase this like button stuff because it helps me pay you more, and people are doing a good job of it.
Great. Yeah, we're getting new subscribers and new likes and comments. It's phenomenal, guys. So it's right down here-ish, Paul. But no, it's funny is whenever we talk about Tesla, it's pretty polarizing. And I read the fanboy chats, and Tesla had another amazing day.
Do you really read those chats?
Well, I like to see what the world thinks, Paul, because you have sort of educated me that the world is probably thinking one way, that we should probably be going the other way.
Wait a second, where do you read these things at? Like, what chats are you going to?
I'm in Tesla groups, and someone will be like, 1,700 a day, we're skyrocketing this puppy. And everyone's like, yep, I told you, this company's incredible. And then one guy will come out and be like, yeah, this stock is worth about $300.
Oh, I don't think it's worth 300, but that's okay.
And they just start laying into it. Like, what data do you have? What kind of idiot are you? Yeah.
What data do you have?
Yeah. And so I guess the point is, yesterday the stock started in around $1,400. I think it rose to almost $1,800. And then I texted you like, wow, can you believe this? At what point do you get in? This puppy's going to 5,000. I went off to a photo shoot, and you texted me later, you better check out Tesla because it had gone back down to about 1,500. So I always say all the time, I hear little birdie Paul on my shoulder talking in my ear about investing in a company that if the kooky owner smokes a J on a podcast or tweets something crazy, the value of the company can go up and down 10 to 15% in a single afternoon. So what are your thoughts about what happened with Tesla yesterday, and why are you still never going to be not never, but still you're a buyer of Tesla?
Seth, we talk about the value investing approach, and Ben Graham always talking about how when you buy a stock, you're buying a piece of a company. So when I look at Tesla, I'm going to go to my Y charts, as we've done in multiple, and let me share my screen here real quick. So I'm the guy that's going to go to Tesla's financial statements. And I'm going to say, okay, if I were buying this company in full, the last year, I see a loss of $860 million. Oh, that's okay. Maybe the previous year was better. Oh, wait. Okay, what about previous year? Oh, wait. What about the previous year? Oh, wait. What about the previous year? Oh, wait. Previous year. Oh, my God. It never showed a profit in a full year. Now, quarterly, they've made money the last 3 quarters. 143 million, 105 million, 16 million. So they are getting better, right? But here's the interesting part. I want to see what their data is going to look like in the second quarter, because if you look at their December quarter of 19 versus the December quarter of 18, the revenue increase was 7.2 to 7.38 billion. So everybody's buying this company saying it's growing, it's growing, it's growing, but it didn't grow a ton in that quarter. Now, first quarter of this year, it did 6 billion versus 4.5. That's a 33% increase. But why was there no growth here? And in fact, the previous quarter from that, 6.8 billion down to 6.3 billion. So I'm looking at going, okay, if the entire story of Tesla is growth, shouldn't we have a lot of growth? And we had growth this first quarter, but I'd be interested to see how the second quarter looks. Cash flow wise, free cash flow is cash from operations less your capital expenditures. It's $1 billion. Oh, that's trailing 12 months. Let's do annual. Last year, $1 billion. Year before that, no free cash flow. Year before that, no free cash flow. Year before that, so they had their first year of free cash flow. They made $1 billion in free cash flow, and the company is currently selling for $280 billion. That's 280 times free cash flow. That means if you buy the company every year, assuming everything goes on out, it's going to go 280. It's going to take you 280 years to get your cash flow back. Okay, so let's assume it's a growth company. If all of a sudden revenue doubled this year, would the stock stay the same? No, it skyrocketed. So again, people are rewarding the company on doing what you already factored in the price to already do. So people are already factoring in this massive growth, but every time there is massive growth, they're making it go up even higher. So you're assuming more and more massive growth. Well, guys, at $280 billion, how much more growing is it going to do? I mean, what's Toyota? Toyota's worth $177 billion. What's Ford? $25 billion. What's Honda? $44 billion. So far we've covered 3 companies, and combined they're worth about as much as Tesla right now. And those 3 companies account for what percentage of the world's car sales? You know what I mean? I look at this going, could it still go up? Yes, it could still go up. But for what reason? And if you have 100 Teslas that you invest in, you're going to end up losing a lot of money at these valuations. And that's just the way I look at it. And yeah, is that hard? Sure, it's hard. It's hard for most people. You know, Seth, it's funny. When I look at my investments today, I go, man, I'm going to be right in a lot of things over the next 10 years. What am I missing? And then I'm realizing, well, the thing I'm missing is the thing I have. I'm not missing it. I don't get annoyed at missing out on this. Like, this doesn't bother me at all. I don't get annoyed that I didn't catch Tesla right here. $188 a share in May of 2019. A year ago, 14 months ago, it's now almost 10 times higher. In fact, yesterday it was like 9.5 times higher in 1 year. I don't know what to tell you. I don't get it. And if you try to justify this, we can look for any reason to justify this. But at some point, you've got to sit there and look at it from a yearly basis going, to justify the current value, it's got to grow 20 times, 30 times from today and have profit that's normal.
Yeah.
Okay.
I bring up, I want to stick with the masses, Paul. I want to always argue this with you. And you're teaching me the discipline of investing, keeping emotion out of it, probably not following the sheeple, Paul, that everyone else is doing. And I want to keep thinking that, this is for the future. Tesla does have a lot of room to grow, but in essence, like something like yesterday, I was literally texting you in the morning, like, hey, let's jump on this train and ride it. And you would have lost 20% of your money in hours.
And what I say to you, by the way?
Well, you always do. You always tend to sort of cover your ass with not guiding people without giving them choice. You sort of said something like, you can do whatever you want, but my stance on this. And so,
I said if you're gonna put a little bit of money towards it and try to dabble, go for it. But if you're talking about retirement on this money, you're gonna get caught because you might be right on Tesla. But if you're right on Tesla, you better believe you're gonna be wrong on something else in the future because you're gonna think to yourself like, oh, I was right on Tesla. This will happen again, and you'll lose everything or lose a lot of money. It happens over and over. This story has been told so many times in history. And you're right, I am covering my ass. But I'm also telling you, listen, the best investors in the world don't make it by making 6 times their money very quickly, unfortunately.
Mhm.
The best investors in the world make it by getting a lot of singles and doubles. That's it. And they just wait and they wait and they wait. And I have that discipline to wait. And I actually look at it and go, it's silly to me to even try to follow this. Like, it's even silly to me. Like, I won't even short this. As much as I think this is ridiculous, I can't even short this because how expensive it is to short this company. It's so expensive to short this company. But you see this parabolic rise here? This never goes like this forever. This never even goes like this and goes like that. It usually goes like this and then, and it always happened. This isn't news. This isn't, I don't know. I'd love to be able to short this company, but I just can't.
I think people jump on board with this, and it was probably me in the future. I'm sorry, in the past. Is that you mentioned the idea of FOMO or fear of missing out, and I guess for me, I don't. I'm not afraid. I guess I don't feel like I'm afraid to miss out, but in essence, I keep thinking, if Tesla can go up 20% in a day, maybe, looking on the bright side, that's 2 years of waiting that you don't have to do if you could get it done in one day. But then it
But
falls.
it can go up 20% in one day. What can it do? What can it go
Well,
down?
so no one wants to think that it can fall 20% in one day, and then you lose the last 2 years of your life. So someone like me that's still under $500,000 in total accumulated cash wealth towards, in saving toward a longer goal. If I lose $10,000 to $20,000 very, very quickly, that's basically how much I invest long term per year. So we had dabbled in some USO earlier this year, and when it plummeted, I basically lost. It's funny, as I sent Fidelity $12,000. I invested in USO and I lost $10,000. And it's like, man, that's sort of what weighs on my mind, is like when I gamble and lose, you almost lose a year of your life. I feel like I'm behind a year. So call that FOMO, but it's just that's sort of the mindset I have. But yeah, so I mean, do you get this? Do you get this feeling from other normal people like myself?
Oh, for sure. It's from everybody, not even normal people. Just, I mean, and hedge fund managers do this. This is like I said, a tale as old as time. I mean, there's a reason why the brilliant Wall Street guys were jumping from buildings in 1928. It's not because they had better discipline than you said. It's because they were exactly like you, except they sat at a desk on Wall Street. So everybody thought they were brilliant. I still remember being in a meeting with a guy who talked about institutional money as the smart money. And I just looked at him and I thought to myself, oh my God, this guy has no clue. And this is a guy worth 10, 20, 30 million bucks. I don't know how much it's worth. He's like, oh, institutional money is a smart money. You got to go where they're going. I'm like, oh my Lord, you clearly don't have an understanding of the history of stock market. Institutional money is chasing returns.
So
They're always, they have to. What was that?
Well, I was just saying, why is it so easy for you to pull up the financials and realize you should get nowhere near this company?
I don't know. I brainwashed myself.
Yet the rest of the world just seems like they jump on board with loving this no matter what the hell happens.
Maybe it's my whole contrarian outlook of things, but I've programmed myself very well over the last years. And I think it also became from frustration of having normal people. I remember once a mutual friend of ours in Mexico was telling me I need to buy land near the airport, near the port in the town in Manzanillo. And he goes, Paul, in a year, it'll be worth double. And I was like, what are you talking about? And then he got mad at me saying, you're not open-minded. I'm like, but if you understood investing, you understood if it was that obvious, it wouldn't actually do that, because somebody else will sit there and say, well, it's going to be worth double in a year. I'll pay 50% more. I'm still going to get 33% return on my money. It's still good enough. And eventually just equates itself out. And eventually it is a musical chairs, and all of a sudden music stops, and whoever's the last one to be standing is going to lose the most money. And everybody thinks, oh, I'll just get out. Well, no, because guess what? Look at this chart of Tesla. Look at the 1 year chart of Tesla, right? Musical chairs. Somebody would have said, oh, I got out at the right time. Well, then they would have missed out on all of this. And this is what drags people in. It sucks people in like, oh, well, look, it went from 900 down to 430, but look, it went right back up to 1500. Okay, but eventually it will not do that. I always ask people, and they tell me this is different. Okay, show me a time when this has ever worked out. Show me a time when stocks did this and then they kept up forever. Doesn't happen. It never, or even not even stocks, every investment. We've been focused on stocks in this podcast lately. Bless you, because it's been the big focus in the media. Real estate's the same way. Bitcoin. Who talks about Bitcoin anymore? Who even talks about Bitcoin anymore?
It was a huge wave when we started making these conversations. All my friends started jumping on board, and I think about 2 months ago, my sister, who God love her, knows nothing about really investing, and she's great in other areas of life, and I still consider myself, I know nothing about investing, but she really doesn't. She said, I still have some Bitcoin. What should I do with it at this point? She's lost her ass on it. And I said, well, it's up to you. I sort of gave her the Paul Gabriel answer. It's like, it's kind of up to you, but I don't even know what to tell her now. Keep it, sell it. If you need the money, sell it.
By the way, it's still high.
It's still high.
But you know what the funny part is? The hype was happening, right?
Yeah.
So when the most hype happens is when it's followed by a crash. This always happens. The most hype, Paul, it's going. You're missing out. It's all about what was the technology behind it?
Oh, right. Blockchain.
Go blockchain, Paul. It's all blockchain. Cool. Now nobody's talking about it anymore.
Yeah.
All right. Sounds good. I mean, this is a very, very common theme. And the other thing is this, Seth.
Well, Paul, it's funny. Go back to that Bitcoin. It's funny. It looks a lot like Tesla stock that jumped there to the left. And at the time, it's funny now that you say that. At the time, people were saying this was different. This is not like your typical stock or your typical money, and this is just going to skyrocket and keep going to $1 million.
I'm actually surprised at 9,000 still.
Yeah,
I'm floored by that. But remember, there's all the value investors out there, and every good investor who's been around for a while. And I'm not trying to pat myself on the back. I'm one of the young ones. Like most people, it takes decades of things before they'll always say the most dangerous words in investing it's different this time. It's the most dangerous word that it happens in every. I remember somebody telling me I was missing out on Twitter when Twitter first went public. Paul, you don't get it. It's different company. It's a different company. It's a different company. I remember it was at $50 a share when he told me that. And guess what? It went to 70 after he said that to me. What's it at today?
34.
34. Got as low as 15. Okay. I don't get it. Where's the hype on Twitter anymore? This is the big thing, Paul. You just don't get it. Okay. I don't get it. And guess what? Guess what else? I'll tell you another story. Google. I was offered Google at the IPO price of $50 a share, something like that, and I said it's too overpriced, and I was wrong because Google ended up being one of those companies that actually performed. They've always been overpriced, but they've been growing and growing and growing. They grew fast enough, legitimately enough, but you don't see these massive parabolic rises in Google prices.
Yeah, you're right.
You don't see them going up 30, 40% a day consistently. You don't see them up 10 times in 1 year. So I was wrong on Google, and I regret Google immensely. But that's one story I can tell. I can tell one story in which I was wrong on all the Paul, you just don't get it stories. All right. And guess what? If I bought it, I'd have made 30 times my money. But if I bought every other hype I was told about, I would have lost tons of money, way more than the gains of Google. That's my point.
Yeah, it's interesting. I remember right about a year after the Bitcoin hype, is I had a friend who he said he researched the ins and outs of Bitcoin upwards of 2 hours a day. And I remember telling him this on a podcast last fall, is he said something like, this company's Bitcoin's either going to be worth $1 million or zero. And I was like, and he was very proud and adamant to say that. And I was like, is that what I really want to hedge my bets on? Because $1 million would be great, but zero would be I don't retire. Not that I put everything.
You know what he's doing there? He's justifying it. There's no research he did to say that Bitcoin should be worth $1 million. All he's trying to do is sit there and say, hey, he's hedging himself there. I'm going for, by the way, dynasty owners the same way, except legitimately it's going to be either worth a ton of money or nothing. Except the chance of it being worth a ton is it is so much smaller than it being worth nothing.
So for listeners out there, Paul has developed a fantasy football game with trademarks and not trademarks, Paul, but patents on how to play a fantasy football game that's very much in line with his investing and business tactics. And it's called Dynasty Owner, dynastyowner.com. And so if you want a serious fantasy football game, it's not like all the others, go to dynastyowner.com. But yeah, Paul,
I mean,
yeah,
we're putting a lot of money into that game. $20,000-$30,000 a month into that game that we have very little revenue, and we're growing the revenue, but it's not enough to cover it. When I say very little, it's not enough to cover it. But that's one of those games. That's one of those things, though. Legitimately, like, okay, if it has 200,000 users in the next 3 or 4 years, it'll be worth a ton of money. But in the meantime, I'm going to absorb a lot of losses.
you,
But again, I have the gains from other businesses to be able to pay for that.
you know, in 2017, when I was really high on Bitcoin, I remember you saying, like, what is it? There's nothing to substantiate that. And so now, over the past 3 years, what you've taught me and hopefully our viewers is when you can look at financials and provide some sort of background as to why a stock costs a certain amount. I now look back at my old self 3 years ago, thinking there's no even financial. Bitcoin was just it's just some sort of fluff, fairy dust in the atmosphere with no real solid, like, why it should be worth something.
And these are bubbles. And one of the conversations is, are we in a bubble? I mean, 100% we're in a bubble. When you see everyday traders saying, there's stories every day coming out of, oh, I have 30,000 in my bank account, I have 1 million. It's like, there's no fundamental reason why they're right. Yeah. We got to weed. That's what happens in bubbles. You weed, when the bubble pops and crashes, you weed people out. You weed out the people who it was easy money for. That happens in every bubble in history. You weed out the easy money and it brings in, and it keeps the good money in there. And it's like, okay, now guys like me can go buy Google at $500, $600 a share because it's a screaming deal, $500 or $600 a share. And then at that point, those people are saying you shouldn't buy stocks. The same people who are hyped up on Bitcoin at 19,000 now don't own it at 9,000 because they got out at 3,000. They got out at 5,000 going, oh my God, I just lost 80% of my money. Okay. Except with companies, at least, you can look at a financial statement and say, okay, people got to remember, when you buy a stock, you're buying a stream of income in the future. So the more you pay for it, the less your return is. That stream's not going to be better because you paid more. People always think, well, if I pay $1,000 a share, what does that mean? The company's still going to do what it's going to do. It's going to make X amount of dollars, whether you buy it for $1,000 a share, $10 a share, or $10,000 a share. So the more you pay for it, the less your return. That's just a fact of investing. The more you pay, the less your return. That's it. And in stocks in the long run, it is based on how the company does in its financials. People don't want to admit that. They don't want to understand that. Why? Because they can't understand these financial statements. And understanding financial statements isn't that difficult. I can help people. I always tell people, look at a company the way you look at your personal life. Revenue is your income coming in. Your expenses are all the way down. At the end of the day, is how much money you're left with at the end of the day. Your balance sheet is your bank accounts, your credit card statements, your home, your mortgages, your debt, your cars, everything. That's all it is. And you understand it that way, you'll be able to understand businesses so much better. Wait, but I don't get it. Tesla doesn't make, if you didn't make money for 15 years, would you be bankrupt? Remember, by the way, Tesla's now worth $1,500 a share, right? Worth. He's admitted that just a year or two ago, they were 2 weeks away from bankruptcy. 2 weeks. And the financial situation has barely gotten better. Yes, he started making money recently. Yes. But immediately thereafter, he wasn't making money still, and he was 2 weeks away from bankruptcy. I don't get that. And if you had a family friend who spent money like crazy and was 2 weeks away from declaring bankruptcy and all of a sudden figured out a way out of it, would you be going, okay, no, they're out of this. It should be worth 10 times more now? No. But we don't look at it that way. Why? Because we look at stocks as this chart and not this. Histories of financial statements and what's behind them.
This is much harder and nerdier to look at, Paul.
People perceive it to be that way. It's not as hard and nerdy as you think. It really isn't. And that's why I tell people, ask me questions on YouTube. Let's figure it. I can help you look at a financial. It's not very difficult. I will break it down into how it's like your personal life. That's all it is. It's money in, money out. That's it.
Wow, Paul, as always, thanks for your insight. Guys, click around on our channel. Paul does these analysis on bad stocks, on good stocks, talks about how to invest. And so we're going to talk about the recent happenings with what Paul thinks is the approaching bubble on our next show.
Not approaching bubble, we're in a bubble.
Smash that like button, subscribe, follow the Everyday Money channel, and as always, thank you, Paul.
Peace out, homie.